Welcome, and thanks, Anna, for a lovely introduction. And so we have a really interesting topic. At least I think it's very interesting. And as much as I have talked to the startups and businesses, I think fundraising and where to get the money to build your business has always been a very important thing, especially now in the current market situation. And I have three lovely panelists, and I talked to them before, and I know there's a lot of good things coming out of the panel. I trust you. So let's kick it off, because we don't have that much time for all the information. But let's start with a very short introductions, just so everyone knows who you are, what you're doing.
I'll start.
Go for it.
Good afternoon, everyone. I'm Federico Travella. I'm the founder and executive chairman of a fintech company called NoviCap. We're the B2B operating system for working capital management and financing. So we help B2B businesses to support them in a holistic way when it comes to working capital, whether that's through credit or lending products or payments products. And this is a business I decided to start after, let's say, a complementary experience, having seen some of the difficulties small businesses go through when it comes to working capital financing. Thank you for being here.
Awesome. And my name is Henrik. I am the co-founder and CPTO of Kapital, also a fintech platform which we built to help entrepreneurs all over the world to grow faster with two things. One is growth analytics, and the other is growth financing using a data-driven approach.
Good. Hi, everyone. I'm Jean Bernard. I'm the CFO of Omio. I don't distribute money, but I distribute tickets for buses, trains, ferries, everything that is on the ground, not so much in the air. So we are a platform, one of the biggest ones you can find here in Europe and North America. And we make it very, very easy and a one-stop shop for when you want to travel, to buy all your tickets with us and follow your trip.
Thank you. You see, this is like you give money, and you know how to spend the money.
So take it.
So I think it's all connected. But just to, before we dive deeper into the different ways how, let's say, companies can get more money besides the regular, let's say, classical startup goes to VC, VC gives the money, and then you scale it. And before we go into the details with that, I think it's also important to understand where we are currently in the market. And I know I think everyone is asking this question, what is happening? Because it feels like there are a lot of things happening every month, and not always the good. I think it's not the good things. And when you think that it's coming out, so something is happening for the good, there's something else happening. So where all of this is going, you have a lot of experience, all of you. So I would like to first hear your opinion. How do you think what's the market is looking like at the moment? Federico, I know you have a lot of numbers. We talked before, so I will give the floor to you first.
The didn't read short version is that the market is not great right now. And if you were to pick an emoji, it's a sort of emoji doing like this, right? I don't know what's happening. And I think maybe taking one step back, if you look at very much what's happened in the last few years, we're a bit like living those hangover effects from the pandemic still. As we went through that unprecedented monetary and fiscal response, 1/3 of the global GDP was injected into the economy in a record time, and so inflation wasn't really unexpected from that perspective. And if you link that with the ambiguity created by the war in Ukraine and high interest rates, it is a very difficult market for startups and tech in general. And the reason for that is very much that VCs, investors in technology, that asset class that they offer to their LPs, their limited partners, those investors in funds, has become less attractive vis-a-vis other asset classes. And this is something that entrepreneurs should be cognizant about, because eventually, we only, or let's say, generally speaking, tech businesses need to raise VC, And as such, you need to be very cognizant of how that counterpart is doing, and they're not in a great moment either.
It's true. And Henrik, you also, like, I think we talked that you founded Kapital also a year and a half ago, which is also sort of, I guess, in the middle of the ongoing crisis.
Yes.
What's your take on the market, and maybe also some observations? What made you create something like that, which is different from the regular VC?
Yeah, exactly. So before Arc, I was at Spotify, and then I was at EQT to build EQT Ventures. So I actually was part of building a VC firm in 2016. At that time, things were very different. So we were really in that bull market where everything went up, 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 which was the really good times for the VC industry and the tech industry. And then came COVID, as you mentioned, and it was crazy to be part of that, I think, firsthand, to see how everything changes, and all of a sudden people were competing across the globe with US VCs coming in and knocking on the doors on your neighbor's tech startup here that you thought you owned as a VC. Super interesting. Of course, that created a lot of really fast or maybe no DD processes when investing in companies at that time. So we at that time really felt like this is not going to sustain long. This is not going to create a good cohort of investments. And here we are. I think now we're getting back to something which is it's going very down right now, but I think it's actually for a good, healthy reason. I think finally we're getting back to actually seeing what's the underlying real profitability or real substance in the investments that we do, which is of course short term a bit troublesome, but in the long run, I think is very healthy for the VC industry. And then obviously also I created Arc because I think there's also a lot of great companies out there that actually, when you look at the data, they're really doing great with their underlying fundamentals actually are working. You have good unit metrics and so forth. They should be able to fund themselves with growth in more ways than just the VC asset class. So that's what we wanted to introduce, which I think we see we have a very good timing to introduce in this market right now.
Yeah, for sure. And JB, you are the more like, I don't want to even say it's not a startup, it's more like a scale-up. And
yes.
How has been your experience in the last years, and I guess from the CFO position to spend the money? How does the market look for you? Do we spend the money?
I keep the money. No, it's really tough. It is really, really tough. We went, obviously, as a travel company through 2 years of COVID that were disastrous. I'll give probably an anecdote afterwards. And we felt that we learned a lot. We secured the company through those 2 years, thanks to our investors and a couple of external investors, but also lenders who helped us through that, which was really great. And we felt that we were coming out of COVID, and now the market is picking up, so it's going to be great. We're going to be able to raise money again and accelerate our growth. And the financial market has almost collapsed, you know. So it's even for us, being a scale-up, being almost profitable this year for sure, next year, it's really hard to raise money. And so you need to come back to your fundamentals, which is your P&L, your own profitability, your own shareholders, and then we can also talk about your own working capital, but finding ways, creative ways to make sure that you can fund your growth going forward. But it's tough, yes.
Well, tough is good. That's what I heard at the other panels and discussions today as well. Like, you know, tough times create a lot of opportunities. But following on that, because I think exactly it's for startups and businesses to create the profitability, at least aim for that, is a good thing, which is maybe even more important now than ever. Let's start. Federico, what's your take on basically, now we kind of move, I guess, into the more details. So we realize the market is not great. What are the alternatives that I guess for example, from a startup perspective that they need to know if they want to fund their business? Exactly, what are the new criteria that they should, because I think with the VCs, it's always idea, team, everything, but I feel what you're talking now, it's more, all of you, it's more about risk, about different criteria that are becoming important.
I think you can do a lot of things as an entrepreneur, and eventually, your number one responsibility is not to run out of money, because then there's no business. And that I think starts with being brutally honest against yourself, right, for yourself, the market has changed. And I see a lot of, for instance, first-time entrepreneurs that are still trying to raise funding, their first, institutional round at valuations which, they really feel like 2021, 2022, and those valuations are gone. If you're not today in AI and you're growing 10x year on year, it's going to be much harder to raise funding, right? And so I think accepting that, first of all, is an important first step, and it sounds logical, but I think many entrepreneurs are a bit hard-headed. And then I think that the second thing I would do is I would indeed look at all the options across what I would call the capital structure. And so VC funding is really only for a subset of businesses which typically have achieved some product market fit, and they need that rocket fuel to accelerate. The reality is that very often that businesses, they raise VC funding too early because they don't have that product market fit, and in the last few years we've seen a bit of that because VCs were trying to fish a bit earlier. But I think if you can bootstrap, if you can find other levers that you can use early stage, whether that's grants, whether that's indeed reducing costs, I think that is a great strategy, and potentially also some of the other funding structures like ARC and others.
Henrik, any?
Yeah, I mean, I usually talk about growing with control, so growth control. I think that's the thing that you should think about as an entrepreneur. And what does that mean? Well, it's not that you need to stop growing and only go for profitability. There is ways that you can continue to grow in an unprofitable way if you have understanding of what your underlying profitability goes towards. How does it look like right now, and what are the trends for that? So if you understand that, then you can forecast where your cash is going to take you, if you're going to make it and turn around before your money runs out. If you have good control of that, then you have a way to actually grow faster than you think in your business. And that's actually also, I think, the best way to raise VC money right now. If you can show that way to profitability further down the line, that's also what will get you your VC money faster. And nowadays we also have more asset classes than VC, so that's what we are trying to introduce. We build a platform to help you get to that growth control, where we do what I did at Spotify, building the analytics platform there to help to visualize and forecast based on your consumer behavior data in your business. How long will my cash take me right now? What's the sensitivities? Will my cash run out? And then we use that then to also offer lending towards that data. So with that, we're using the analytics-driven approach to actually create a new type of lending that was impossible before. So that's a new addition to the market. So that's a new introduction to be able to grow for more entrepreneurs.
Yeah, and I would complement. We did, I think, 3 essential things at Omio. One was exactly what Henrik said. We started looking at how and what do we need to do in order to be the master of our own destiny, and exactly spend a lot of time predicting where our cash is going to go, where our own cash is going to go, etc. And we turned a lot of levers to make that happen. The second thing we did was we took some money at the beginning of just before COVID to VC debt, and at the time the interest rates were outrageous. And by today's standards, they're kind of like nice. We want to keep it. It's really funny to see how things change radically, but that was very good for us. And then the third thing, to come back to an anecdote, so the 23rd of March, when the first lockdowns hit, we completely, we saw 95% of our customers asking to refund their tickets. And we did the math, and that was like 3 times the amount of money we had on the balance sheet at that one time. And so we went through very, very tough times. But we discovered that you can do, for instance, vouchers. So you tell people, don't worry, you're not going to lose your tickets, but we're not going to reimburse you. And that saved us, because we managed to slow down the repayment to customers, and then eventually we didn't have to pay most of them, etc. More recently, what we've come back is to say, hey, those vouchers, they worked really well. Can we do the reverse? Can we actually use our clients to fund ourselves? And so what we are trying now is selling vouchers in advance. And obviously there is an incentive for clients, but you say, give us your money, buy 5 tickets in advance, we'll give you a discount. And that fuels your growth, and you do this kind of thing. So think of all of that. It's not just about cost reduction. It's not just about getting money. It's also kind of like how do you create incentives for your customers.
I think pricing and contracting are great levers for growth. There's a company that I know very well. They first switched from monthly billing to more annual licenses, right? And obviously that license is paid up front, and that's dramatically changing their working capital cycle. Another very good example I've seen is a business that originally started with a SaaS solution in the enterprise segment. And we all know enterprise is, is long sales cycles. It's, you can, if you're selling SAP, to give an extreme, you're selling it for, 1 or 2 years before they convert. And so they switched to the SME segment, so small, medium businesses, and that has a much quicker conversion rate. And another business that I've seen did something very interesting as well. They unfortunately had to reduce headcount when it comes to Salesforce. And so they switched from a pure fixed cost, I have my own Salesforce, to externalizing their Salesforce and only working with partners. Referring them business, and obviously you pay them, but you very much move from a fixed to a variable cost when it comes to your sales.
That's very interesting. And I think, well, sounds like it's true. Like, the tough times do create opportunities, because I think the founders have to become creative in the ways.
Yeah. It's the opposite of, we've all taken Uber, and, mobility startups have been spamming us with vouchers, right? And I think that is the extreme opposite, where it was very, it was free money that people were giving away, and that's something which is changing.
Yeah. I think we could talk for a while, but I know that we are also slowly running out of the time, and I want to ask the final kind of the topic to close up also the panel, because of course we understand, well, the market it is as it is. It's not easy. There are other ways, though, to finance the startup, but the startup founders have to be creative and actually a bit more tough than maybe before. But so the last thing is what I think everyone wants to know as the classical one, what's happening in the future, which I guess no one at this point can tell, but I still would love to hear your takes on the future, because then also maybe some suggestions for founders, for business owners to what are the suggestions, and what exactly, besides all of this that we already talked about, the sustainability, like profitability, but still. And then there is a twist, because we also talked, because I think there is a future until the end of this year, so very immediate future, and for some I know that still are we running out of money or not, and then of course there is a future, so what happens next year. So maybe quickly some guesses of the short-term versus longer-term future, how scared we need to be.
Well, I think I've seen some signs that it is slightly turning now. I think when I talk to VCs now, I think I see some glimpse in their eyes, and I think they're actually starting to do investments again. So I think it's hopefully about to change right now. And then I think when we come out on this other side, I do think we are more sustainable when we grow our businesses and when we do the investments, and also that there are more alternatives actually out there right now. So I am optimistic about the future when the tide comes back again. Now I think we're going to see faster companies companies growing faster than before, and more companies growing faster than before, thanks to the combination of these two things.
I think that glimpse of hope in the VC's eyes is very AI-driven right now. I think AI was like the perfect excuse to start investing again, because Web3 obviously went out of fashion. My base case assumption is that the market's not gonna accelerate. It's not gonna be easier to raise, because even though we're not structurally or technically yet in a recession and a slowdown, all the factors are there, right? So we have high inflation, which is quite persistent. We have a very high debt burden across the entire economy, including corporates, but also governments, not to bring up the topic of the debt ceiling in the US. But if you see default rates going up to 5-10% already this year, in markets like the US, and if that goes to 8 or 10%, it's going to trickle down into the real economy as well. So I think 6 months this year, base case assumption is that flat in terms of speed VC funding, And next year is really going to depend whether we are in more recessionary times with the entire economy, and eventually VCs and startups form part of that. So unfortunately, we'll also have to follow that rhythm.
JB?
Yeah, I would say that we try, and I really encourage everyone to take a very pragmatic approach of read the market, talk to your investors. They usually have a good read, they see the portfolio, what's happening, etc. Take a conservative approach. We're not expecting to raise money in the next 18 months, for instance. It may not be the case for everyone, but at least in our case, that's the hypothesis we have taken. And see what you can do with that, or if it produces big changes on your company, accept it. It's time to change, because I don't think it's going to revert very, very soon, unfortunately. No.
And I think those are the very good words to finish the panel as well. It's time to change, and hopefully for good. Thank you so much.
Thank you very much.
Thank you for
Thank you.
listening.
Thank you, everyone.